Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Valuation Techniques in Value Creation. Valuation techniques are foundational in understanding corporate finance and value creation. These techniques allow financial analysts, investors, and corporate managers to assess the worth of a business, investment, or project. Valuation is critical for making informed decisions regarding mergers, acquisitions, investment opportunities, and overall financial strategy. The primary goal of valuation is to estimate the intrinsic value of an asset, which can then be compared to its market value to identify overvalued or undervalued opportunities. Key valuation methods include discounted cash flow analysis, comparable company analysis, and precedent transactions analysis. Pause. The discounted cash flow analysis is grounded in the principle that the value of an asset is the present value of its expected future cash flows. This method requires forecasting the cash flows the asset is expected to generate and then discounting these cash flows back to their present value using an appropriate discount rate. The discount rate typically reflects the weighted average cost of capital, which accounts for the cost of equity and the cost of debt, weighted by their respective proportions in the company's capital structure. DCF analysis is widely respected for its rigorous approach and theoretical soundness. It is particularly useful for valuing companies with predictable and stable cash flows. However, the accuracy of a DCF analysis heavily depends on the quality of the cash flow projections and the appropriateness of the discount rate used. Small changes in these inputs can significantly impact the valuation outcome. Comparable company analysis involves valuing a company based on the valuation multiples of similar companies in the industry. Common multiples used in CCA include the price-to-earnings ratio, enterprise value to EBITDA, and price-to-book ratio. The process involves selecting a peer group of comparable companies, calculating the relevant multiples for these companies, and then applying the median or average of these multiples to the target company's financial metrics. CCA is advantageous because it is relatively straightforward and relies on market-based valuations, which reflect current investor sentiment. However, the method assumes that the comparative companies are truly comparable, which may not always be the case due to differences in size, growth prospects, and risk profiles. Precedent transactions analysis is another relative valuation method that involves examining historical transactions of similar companies within the same industry. This method is particularly useful in merger and acquisition scenarios. Analysts collect data on previous transactions, including the transaction value, financial metrics of the target companies, and the multiples paid. By analyzing these precedents, an analyst can infer a valuation range for the target company based on what acquirers have historically been willing to pay. PTA provides a market-driven valuation benchmark, but can be limited by the availability of relevant transactions and the unique circumstances surrounding each deal. Understanding these valuation techniques is essential for value creation, which refers to the process of increasing the worth of a company for its shareholders. Value creation can be achieved through various strategies, including operational improvements, strategic acquisitions, financial restructuring, and innovation. Operational improvements involve enhancing the efficiency and effectiveness of a company's operations, which can lead to cost reductions and increased profitability. For instance, implementing lean manufacturing techniques or optimizing the supply chain can result in significant cost savings and higher margins. Strategic acquisitions can drive value creation by enabling companies to enter new markets, acquire new technologies, or achieve economies of scale. A well-executed acquisition can create synergies that enhance the combined entity's value beyond the sum of the individual companies. For example, Disney's acquisition of Pixar in 2006 allowed Disney to leverage Pixar's superior animation technology and creative talent, resulting in a string of successful animated films and increased revenue. Financial restructuring involves altering the capital structure of a company to optimize its cost of capital and improve financial performance. This can include actions such as refinancing debt, issuing new equity, or repurchasing shares. A balanced capital structure can reduce the cost of capital, increase financial flexibility, and enhance shareholder value. For instance, Apple Inc. has successfully used share repurchase programs to return excess cash to shareholders, thereby increasing earnings per share and boosting stock prices. Innovation is a critical driver of value creation, as it enables companies to develop new products, services, and business models that meet evolving customer needs and create competitive advantages. Companies that invest in research and development and foster a culture of innovation are better positioned to sustain long-term growth and profitability. For example, Tesla's continuous innovation in electric vehicle technology has allowed it to capture significant market share and establish itself as a leader in the automotive industry. In summary, valuation techniques such as DCF analysis, CCA, and PTA are essential tools for assessing the intrinsic value of assets and making informed financial decisions. These methods provide a framework for evaluating investment opportunities, mergers and acquisitions, and strategic initiatives. Value creation, on the other hand, involves implementing strategies that enhance the worth of a company for its shareholders. Operational improvements, strategic acquisitions, financial restructuring, and innovation are key drivers of value creation. By understanding and applying these valuation techniques and value creation strategies, corporate managers and investors can make better decisions that contribute to sustainable growth and increased shareholder value. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.